Is your real estate strategy built on appreciation? Because if your plan is to buy a property and hope it appreciates, you're not investing, you're speculating. We know a lot of high-income earners who jump into real estate for the tax benefits. And don't get me wrong, the tax advantages are incredible. But the problem is they're relying on appreciation to make the investment work. And that's where things can go wrong. In this video, I'll show you why relying on appreciation alone is one of the riskiest mistakes investors make and what to do instead. By the end, you'll have a framework for investing that doesn't rely on luck or timing, one that helps you build wealth predictably even when things don't go your way. And in just a minute, I'll share real data from a market that supposedly always goes up and how one investor learned the hard way that even the best markets don't always go up forever. If you're new here, I'm Dr. Kenji Asakura. I've been investing in real estate for over 25 years. My wife and I have built a portfolio of over 180 rentals. Plus, we are general partners on thousands of syndicated units, and we've taught over 4,000 doctors and other high-income earners how to invest in real estate the right way. And just as a quick disclaimer, this video is for educational purposes only. It's not investment, legal, or tax advice. Always do your own due diligence and consult your advisors before making investment decisions. Now let's start with one of the most common and probably the most irresponsible belief in real estate. A friend once told me, prices never drop in Hawaii. Now I get where that belief comes from. When you live on an island with limited land and steady demand, it's easy to assume values only move up in one direction. But the data tells a different story. If you look at the FHFA House Price Index for Honolulu, prices fell from 1996 to 2000. They dropped again between 2007 and 2010. And in the past few years, we've seen some of the biggest swings in value in decades. Even markets that feel bulletproof experience corrections. In fact, over the past 50 years, nearly every US housing market has seen home prices fall at some point. So the idea that prices never fall here, it's more myth than fact. And whenever someone says, this market is different, you know better. Because confidence in appreciation has cost investors millions, often without them realizing it until much later. And if you think that's just theory, wait until you hear about the buyer who overpaid for one of our properties and what happened when their entire strategy depended on appreciation. A few years ago, we bought a property for $430,000, did a full renovation, and when all said and done, it cash flowed well and we forced a lot of appreciation. Eventually, we sold it for $870,000, double what we paid. But here's what's interesting. At that higher price, the property no longer cash flowed. The numbers didn't work, yet the buyer still bought it. Later, we learned that they were having trouble qualifying for new loans. We discovered why. None of their properties were cash flowing. Their entire portfolio was built on one assumption, that prices would keep going up. That's the danger of playing the appreciation game. When your whole portfolio depends on the market staying hot, you're not building wealth, you're gambling with it. And lenders see it too. You stop looking like an investor and start looking like a liability. You're constantly covering expenses out of pocket, hoping appreciation will bail you out. But if prices drop, or even just flatten, your whole strategy falls apart. And the scariest part? We've seen it before on a national scale. Back in the early 2000s, credit was easy. You can get an adjustable rate mortgage with little to no income verification, something called a stated income or no doc loan. The problem was many of those properties didn't cash flow. Owners were paying out of pocket every month just to hold them. And when rates adjusted higher, those payments jumped, sometimes by thousands. At the same time, property values started to fall. It was a perfect storm. No cash flow, rising carrying costs, and no way to sell without taking a loss. According to the Federal Reserve's All Transactions House Price Index, the US housing market peaked in the first quarter of 2007, bottomed out in the second quarter of 2012, and didn't return to pre-2007 levels until the fourth quarter of 2016. That's almost 10 years just to break even. 10 years of waiting, hoping, and watching equity stay frozen. Now imagine buying in 2007 and having your equity tied up for an entire decade. No growth, no gains, nothing. That's a lost decade. If your property cash flowed, you could ride out the storm. But if it didn't, you were stuck writing checks every single month just to hold on. Imagine a decade of that across an entire portfolio, just waiting for prices to recover. That's not wealth building, that's financial quicksand. And I know that feeling all too well because I've been there. In fact, let me take you back to my early investing days when I learned this lesson the hard way. It's one thing to see it in data, it's another to live through it. I'll be honest with you, I've played the appreciation game myself. Early in my investing career, I bought condos that didn't cash flow. I told myself they'd appreciate. Some of those bets paid off. I sold a few for quick profits, but others crashed in value. I had to wait it out for several years until prices recovered, holding properties that were cash flow negative the entire time. That meant paying out of pocket every month just to keep them afloat, and in some cases, I had to sell at a loss. I had no control over the outcome, and that's the problem. It's speculating, not investing. It's not a strategy you can rely on. So based on that experience, My wife and I developed a strategy that works in any market. But before I break down the strategy we developed, let me start by addressing the hype that gets so many investors in trouble. Why do so many people still chase appreciation, even when they know it's risky? I understand the appeal. It's emotion. Appreciation plays can feel exciting. They promise quick gains and the illusion that returns are dependable, and that little dopamine hit you get when the market's hot. It's the illusion of control. It makes you feel like you're making smart moves, but really, you're just riding the wave and hoping it doesn't crash. I see it all the time. Investors chasing luxury condos, speculating on land deals, new development projects, convinced that prices will always go up. But here's the truth most people don't want to hear. Appreciation isn't guaranteed. And when that's your only play, you're one market shift away from losing years of progress. Now, appreciation can have a place in your portfolio. A little exposure to higher upside opportunities is fine, but it should never be the foundation of your entire real estate strategy. Because when too much of your portfolio depends on high risk, high return bets, you're not building wealth, you're gambling with it. So here's the mindset shift that's really important to make. Real wealth comes from risk-adjusted returns you can depend on in any market. And to do that, you have to remove the emotion from the equation. Excitement should never be the reason you invest. Predictability should be. Now let's get practical because I'm going to show you exactly how we build predictable wealth by tapping into not one, but 6 ways to make money with real estate. And once you see how these 6 work together, you'll never look at investing the same way again. So what's the alternative to playing the appreciation game? It's simple. You invest in properties that pay you in multiple ways, 6 to be exact. Let me walk you through them one by one. First, cash flow. This is the steady, predictable income that comes in every month from your tenants. Cash flow is what lets you sleep at night and hold through any market cycle. Second, debt pay down. Every month, your tenants are helping you pay off the mortgage. But this only works if the property actually cash flows. If you're covering shortfalls out of pocket, this benefit disappears. So debt pay down isn't automatic. It's your reward for buying right. Third, immediate appreciation. This happens when you buy below market value. From day one, you built in equity, and that's appreciation you don't have to wait for. Fourth, forced appreciation. This is one of my favorites. It's the appreciation you create through renovations, improvements, or better management. It's appreciation you control, not the kind you hope for. Fifth, the tax benefits. When you own your own rentals, you can take full advantage of the tax strategies available to active investors, benefits you don't get when you're just passively investing. It's about using real estate to shelter your income, and if you can shelter all of it, you get the maximum benefit. Because when you're paying 0 in income taxes, you're not just keeping more money, you're accelerating the growth of your wealth. And finally, the 6th one is market appreciation. It's great when it happens, but it's a bonus, not a plan. It's not something we like to build our entire real estate portfolio around. And when you stack all 6 together, cash flow, debt pay down, immediate appreciation, forced appreciation, tax benefits, and market appreciation, you're not relying on luck or timing. You're building wealth systematically. Next, I'll show you how we stacked all 6 of these income streams on one deal, so you can see exactly how it works in practice. But first, let's contrast what this looks like with 2 very different investors, one who follows a disciplined system and one who doesn't. And this comparison will show you why control, not luck, is what separates investors from gamblers. Let's compare 2 investors. Investor A follows a disciplined system. Investor B is hoping the market stays hot. Investor A buys at a discount, adds value, creates cash flow, captures tax savings, and treats market appreciation as a bonus. Investor B buys at retail, ignores cash flow, and counts on the market to do the work for them. Do you see the difference? One has control over outcomes, the other depends on conditions they can't control. And that's the key distinction between professional investing and gambling. Real investors play a game of predictability, not hope. Because when you can control multiple components of return, the market no longer controls you. Next, I'll show you why that distinction matters more now than it has in over a decade, and how today's rate environment has turned the tables for investors who actually know what they're doing. This is especially important right now. Mortgage rates are high, affordability is low, and in many markets, prices have started to correct. If rates stay where they are, values could remain flat for years. And if rates move higher, prices could decline further. So think about this. If you buy a property today purely for appreciation, you could end up waiting a long time for values to rise again, all while covering carrying costs out of pocket if your property is cash flow negative. And that's not just waiting, that's slow financial erosion. Negative cash flow doesn't just hurt your returns, it drains your savings, limits your options, and makes it harder to invest again. That's why right now, more than ever, you need a strategy that works in any market, because hoping for appreciation isn't a plan, it's a liability. And here's what most investors miss. High rate environments don't eliminate opportunity. Instead, they eliminate investors who have the wrong strategy. And they reward the investors who buy right, who understand leverage and who can hold long enough to win. And in a second, I'll show you exactly what this looks like with a real deal where we stacked all 6 ways of making money on one property. You'll see how every decision, from purchase to sale, was designed to create control, not hope. Let's walk through what this looks like in practice. We bought a duplex for $176,000. It was an estate sale. The kids wanted to move it quickly and didn't know the real value. We ended up buying it about 15% below market, roughly $26,000 of immediate appreciation on day one. Then came another part we could control: cash flow and forced appreciation. The rents were well below market, so we brought them up to where they should have been. We then renovated both units, which allowed us to increase rents even more. And we didn't stop there. We converted the garage into a rentable workspace, adding another income stream. Those steps created forced appreciation and increased our cash flow far above 10%. Every month, our tenants were paying down the mortgage. That's debt paydown, while the property continued to cash flow. Because we were actively involved in the management of the property and renovations, we were able to take full advantage of the tax benefits, using depreciation and other strategies to shelter our physician income. A few years later, we sold it for $385,000, more than double what we paid for it. Yes, it was market appreciation, but we didn't rely on it to make us money. We made money on this investment because we tapped into all the ways to make money: the discount going in, cash flow, debt pay down, forced appreciation, and the tax savings. Even if prices hadn't gone up, it still would have been a great investment. That's the beauty of the strategy. You don't wait for the market to make you rich. You use multiple levers that keep paying you no matter what the market does. And that's what gives experienced investors staying power: the ability to hold through down cycles, stay liquid, and keep building while others sit on the sideline. So here's the bottom line. If you're buying properties that don't cash flow and hoping they'll go up in value, you're not investing, you're gambling. If you want to build real wealth, focus on cash flow first, then stack all 6 returns. That's how you build resilience, and that's how you create the staying power to thrive through any market cycle. Because hope isn't a strategy, and appreciation, that's not a plan. If this challenged the way you think about investing, take that as a good sign. It means you're starting to think like a true investor. And if you're a high-income earner ready to learn how to invest the right way without gambling, and you're ready to take action, just click the link below to book a free strategy call. Our team will show you the steps you can take to get started today. We'll walk you through how to buy your first property using this exact framework, step by step. I'm Dr. Kenji Asakura. Thanks for watching, and I'll see you in the next one.